Something seismic just dropped into the silver market. And if you blink, you will miss the single biggest repricing event many investors will see in their lifetime. A veteran analyst with 4 decades of macro history laid out a conservative $200 per ounce target by mid-2026, and a mania case that could push multiples beyond that. That is what happened. That is the headline. That is what this video is about. I'm your host. Quick intro, no fluff. And in the next minutes, I'm going to break down exactly why that number isn't fantasy, why the internals of this market look nothing like a normal rally, and what you should do if you want to protect and possibly multiply your capital. No drama, pure delivery. First, the new behavior is obvious. Price dips no longer stick. When silver slid recently, buyers reset the floor in days, not months. That alone tells you the buyer profile has changed. These are not flip traders hunting pennies. These are industrial manufacturers, strategic buyers, and sovereigns buying metal to use. When a 16% pullback is treated like a shopping list, you should sit up. Here's the core shift, 4 forces converging at once. Force 1, structural industrial demand. Solar panels, EVs, high-performance electronics, and expanding data centers use silver in ways that can't be swapped out easily. Force 2, persistent production shortfall. For years, we've consumed more silver than we mined. The gap isn't random, it's structural. Force 3, monetary flows. Central banks and sovereign funds are accumulating hard assets. Force 4, technical breakout. Momentum readings have flipped from slow to fast. Stack those and you get regime change. Let me be blunt. Supply cannot flex quickly. Mines don't spring up overnight. Permits, capital, logistics, it takes years. That means when industrial demand accelerates, price is the only fast lever. And price moves quickly when the market wakes up to the math. Look at market internals. The gold-silver ratio is a glaring signal. Silver is a much smaller market than gold. When capital rotates into hard assets, silver must move farther to absorb flows. If the ratio compresses to historically tight levels, silver's upside is amplified. Small amounts of capital can produce huge percentage moves. Technical momentum isn't polite either. The market busted through a long cap. When momentum goes parabolic, the usual sell triggers turn into noise. Remember past breakouts. Exiting on the first overbought signal often means you miss the meat of the run. If you trade like normal in a structural shift, you will likely exit too early. Now the reality check. Volatility will be brutal. Corrections are guaranteed. Legendary resource investors note that major commodity rallies throw violent pullbacks mid-run. That is not a failed trend. It's a cleansing. You must be prepared for 20-40% swings without mistaking them for the end. So what does positioning look like? Think in 3 lanes. Lane 1, physical metal. In an industrial squeeze, raw ounces beat collectability. Factories need atoms, not packaging. Focus on low-premium, high-density forms. Recognize government or major corporate bars and rounds. Accumulate in tranches. Dollar cost averaging reduces timing risk. Lane 2, miners. This is leverage. Mining equities multiply profits when spot explodes, but not all miners are equal. Avoid hedged producers with forward sales. Those contracts lock away upside. Favor unhedged primary silver producers in stable jurisdictions with clean balance sheets. Juniors with funded programs can return outsized gains, but expect insane volatility. Lane 3, strategic exposure. Jurisdiction matters. OEMs and governments will favor clean sources for critical materials. Mines in stable allied countries command a premium. Political risk can turn a good asset into a trapped asset overnight. Now the math, don't let anyone tell you the numbers are soft. If industrial adoption adds tens or hundreds of millions of ounces annually, marginal demand compounds quickly. Recycling is slow. Much silver is dispersed across devices and costly to recover. Batteries lock metal away for decades. Near term, the market is price-driven, and that is explosive. Market mechanics matter. Exchanges are changing contract specs, raising margins, and launching new products to meet retail and industrial demand. Physical premiums diverging from paper prices create arbitrage that forces sharp moves. When Asia trades at a premium to Western futures, arbitrage can gap the paper market higher fast. Watch hedging books at producers closely. A miner that sold future output at low prices misses the rally. Unhedged miners become magnets for capital. Battery makers might even buy equity in miners to secure supply. That action re-rates valuations fast. Governments create a paradox. They mandate EVs and green tech but may face supply bottlenecks for critical metals. If silver becomes strategic, expect allocation, preferential contracts, or export controls. That can prioritize industrial buyers and temporarily reduce retail liquidity. If you own metal, be aware that regulation can alter access. This isn't guaranteed winners, it's asymmetric odds. Downside from current levels with a confirmed structural floor is finite compared to upside if supply-demand math accelerates. But conviction is not recklessness. Position size matters. This belongs in an aggressive sleeve of a diversified portfolio, not in your emergency account. Engagement. Do you own physical, miners, or ETFs? Drop a one short line. Physical, miners, or ETFs? And tell us which lane you prefer. Also answer this. What scares you most about a silver surge, volatility, or government involvement? One word each. I read top replies. Quick subscribe prompt. Want the next video where we model demand curves and run worst case versus base case scenarios? Hit subscribe and the bell. Short CTA. Useful content. History repeats in patterns. Commodities that base for decades often erupt when fundamentals and technicals align. Copper, nickel, uranium, each showed compressed explosive moves when supply failed to meet demand. Silver is smaller and more reactive. When the crowd recognizes the shift, retail rushes will be obvious and swift. Skeptics say miners will flood supply if prices spike. That's naive. Mines take years to bring online. Ore grades are falling. Political constraints limit rapid expansion. Price is the only immediate balancing factor. Skeptics also point to recycling. Reality, silver recycling rates lag because the metal is dispersed widely. Recovery often costs more than the metal. Even aggressive recycling programs take years to materially increase supply. The psychological battlefield will be brutal. Media will oscillate between dismissal and breathless coverage. The pro-money accumulates quietly. The public buys late. That's the pattern. By the time the mainstream is all in, much of the move is behind it. Tactical checklist you can use now. Decide your lane. Physical, miners, or a strategic exposure. If physical, buy low premium bars, diversify storage, avoid collector premiums. If miners, eliminate hedged producers, favor primary silver names in stable jurisdictions. Timing, ladder in with dollar cost averaging over weeks, avoid front loading with FOMO. Exit, set targets and trailing rules based on multi-month horizons, not daily noise. Leverage warning, margin magnifies returns and destroys accounts in volatile markets. Use leverage only if surgical and able to survive margin calls. Let me paint 3 realistic scenarios so you feel the numbers. Scenario A, conservative base. Demand rises modestly. Recycling helps. Mines expand slowly. Prices move meaningfully over a year. You profit through weight and select miners. Scenario B, accelerated adoption. Factories scale faster. Market moves 2x, 4x in months. Unhedged miners and funded juniors surge. Scenario C, shock squeeze. An OEM fast tracks a silver-intensive design. Sovereigns buy. Physical premiums spike. Paper shorts scramble. Delivery squeezes create violent gaps. Which scenario wins? I can't tell you, but stacking structural drivers makes moves larger and faster than most expect. Tactical details that matter. Storage. Choose home, allocated bank vaults, or private vaults. Home gives control, but risk. Allocated vaults cut theft risk, but add counterparty exposure. Private vaults can be insured middle ground. Document chain of custody. Liquidity. In squeezes, dealers favor industrial refineries. Large recognized bars hold depth. Odd pieces trade erratically. Taxes. Precious metals have differing tax rules by country. No capital gains treatments and custodial options. Consult a tax pro. How to evaluate a miner. Read filings. Avoid producers with forward sales. Favor unhedged primary silver operations in secure jurisdictions with strong balance sheets. Management competence matters. Junior diligence. Seek transparent reporting, funded programs, and clear timelines. Unfunded speculative stories are lottery tickets. Catalysts to watch. Permits, drill converts to reserves, unhedging, strategic buys by industrials. Any can re-rate a company quickly. Conversely, strikes or poor metallurgy can collapse juniors overnight. Psychology. Professionals accumulate quietly. Retail buys late. Track insider buying and primary market signals for institutional conviction. Arbitrage. Monitor divergence between paper and physical prices. When Asia trades at a premium, arbitrage can force violent repricing. Regulatory risk. If silver is declared critical, expect allocation to industry. That can reduce retail liquidity and prioritize OEMs. Exit mechanics. Predefined profit rules. Partial sells at milestones and trailing rules tied to multi-week averages. Lot gains without chasing tops. Tactical ideas. Identify unhedged low-cost producers, juniors with funded high-grade drills, and accumulate low-premium bars on a DCA schedule. Small options. Bets give asymmetric risk with limited downside. Signals to watch. Rising delivery notices, Asian premiums, long-term supply contracts, and insider accumulation. Any of these accelerate repricing. Protect the core. Hold a base physical position you don't trade. Use a tactical sleeve for miners and options to avoid emotional selling during volatility. Now let's quantify simple scenarios to visualize impact. Imagine a modest shift that adds 50 million ounces of industrial demand annually. At current mine supply that widens a deficit and pushes premiums higher, Now imagine battery and solar demand together at 150 million ounces per year. That scale forces reallocation of stockpiles and quickly raises prices. Rule of thumb, when demand grows faster than recycling and mining can respond within 5 years, price clears the market. Low marginal cost producers capture outsized profits. Hedged producers miss the upside. Watch measurable markers, delivery notices on exchanges, sudden mint sellouts, widening premiums in major hubs, regulatory notes on critical minerals, and strategic sovereign or procurement buys. Read price action. Quick recoveries after steep pullbacks indicate deep support. Corrections that drag weeks show weaker demand. Rising volume on rallies and low volume on declines signals accumulation. Entry discipline. For physical, ladder in weekly or bi-weekly. For miners, buy after catalysts and set clear stops. Keep leverage plays small enough to survive total loss. Macro backdrop matters. Monetary easing, sovereign gold buys, or bond stress accelerate flight to hard assets. In that environment, silver often outperforms due to its industrial shortage overlay. Information edge comes from digging, filings, patents, and procurement notices. Institutional buyers secure long-term offtakes. Retail reads headlines. OEM contract language or patent references to materials are top-tier signals. Weekly practice. Check 3 metrics. Physical premiums in major hubs, mine production updates, and delivery notices. If 2 trend higher, consider adding exposure. If they reverse, consider trimming. Risk rules: avoid FOMO, don't over-leverage, diversify within your aggressive sleeve, and document your thesis. Review monthly and adapt. Concrete action: set alerts for announcements linking industrial demand to silver use, OEM procurements, patents, or exchange draws. These are early warnings. If you want the deep numbers, I will publish the spreadsheet with adoption curves and mine timelines. Subscribe and enable notifications. I'll walk through the model live and show the choke points. Quick recap checklist. Determine your lane, set allocation limits, buy weight, not artwork, avoid hedged miners, track premiums and delivery notices, and keep a cash reserve for tactical buys. Prepare mentally for violent swings and plan exits in advance. The next video will be a live walkthrough of the spreadsheet. Real numbers, real timelines, and clear guardrails. If you're serious, subscribe now and enable notifications. I'll show the model, answer questions, and mark the exact moments when risk to reward are optimal. Sign up. Subscribe, comment your lane, and I will pin the best takes. We'll run the math next.